Are you wondering why housing prices haven't crashed just yet? Well, in this video, I'm going to be giving you my 2021 market update, what you need to be watching, and how different markets are moving independently. And of course, what we should all be doing depending on whether you want to buy, sell, or invest. So stay tuned. Hey, welcome back, tribe. Jonathan here. This is a question many are asking, and in today's video, I want to answer it for you. As always, I'm going to show you the data behind the data instead of making claims without the appropriate evidence so that you can decide for yourself what you believe is accurate and what you believe is likely to occur based off the data that we have. In order to create the context for what I believe we can expect, what kind of story we believe will be told in 2021, we need to get a grasp on the setting of the story that happened in 2020. And in order to do that, we've got to set the economic setting. So once upon a time in 2020, there was economic volatility that caused quite a stir. What's going on economically? Really a real roller coaster of a ride. We had a record quarter-over-quarter drop back in the second quarter, 31% decline in the GDP, which typically is how people measure the economy, and then a 33% swing up in the third quarter. And for those of you that failed basic math, that doesn't mean we're actually ahead of where we were. We're still a little bit behind. So if you take away the 31% and then build 30% on top of it, you're not quite where you were. Now, because we've seen such a huge spike in COVID cases, odds are that we'll still see positive numbers for Q4, but at a lot slower rate than we saw in Q3. The important thing to note here is that a lot of economists are hedging their bets on where they see 2021 going until we have some kind of idea how quickly and how widely these vaccines will be distributed and how effective they prove to be in getting this pandemic under control. What about the unemployment story? Well, this I think is one of the most important stories of this year, and in particular, the bifurcation of Wall Street and Main Street. Wall Street surged to record highs, while Main Street has fallen to record lows. We've seen unemployment rates do just ridiculous things. Looking at this chart right here, we saw unemployment rates go from about 3.5%, which was the lowest they'd been in 50 years, to almost 15% in 1 week. It was an unprecedented jump, and we've seen the numbers come down pretty dramatically since then. They're headed in the right direction, but we're still seeing an unusually large number of claims, somewhere in the neighborhood of 800,000 new claims every time they announce the numbers. So moving in the right direction, but the improvement has slowed down quite a bit. Now, let's talk about continuing claims. We've seen the same sort of thing happen there. The unemployment rate spiked. You saw people who were unemployed for longer periods of time, and that's probably a more important number to watch as we move forward, because the way we'll know we're getting out of the recession is how quickly the jobs recover. Well, how quickly have they recovered? In this chart, well, this picture tells a story that if you look at the long line that goes all the way across the page, that's how long it took us to get back to normal levels of employment during the Great Recession. It was called in the media the longest sustained period of economic growth, but you can see how slow that growth was. It took us a decade to get those jobs back. If you look at what happened this time, and that's the red colored line at the left-hand side of the chart, we had a V-shaped recovery in terms of jobs. We got about half of the jobs back in about a month and a half, which is crazy. But you can see that the growth rate in terms of the jobs returning has begun to slow. What that suggests is that it might take us a couple of years to fully recover those jobs. And that's jobs both in terms of where we were, but also in terms of where we would have been if we hadn't had that interruption in the growth rate. A couple of things to point out here that makes this different than prior recessions and has very specific implications for the housing market. One, is that, again, typically when we have job losses in a recession, they're permanent job losses. And it's going to take a long time for them to come back. In this case, a lot of the job losses were temporary, and they were filed as temporary job losses when people filed for unemployment. And you see that again, about half of them came back in a fairly short period of time. The other thing that's different is this recession was really focused on a handful of industry segments: retail, restaurants, travel, tourism, hospitality, entertainment. And those markets or those segments tend to be populated by employees who are hourly wage earners, who are fairly low paid in the overall scheme of things. They tend to be younger, they tend to be less formally educated, and they tend to have very low home ownership rates. So this particular recession skewed much more heavily in terms of job losses towards renters than it did towards homeowners. And that's one of the reasons why the home ownership rates are actually at a 10-year high right now. It's because we haven't seen this kind of fallout in the housing part of the market that we would typically see in a recession like this. Now, what about existing home sales? Well, while all this is going on, and it's been almost unfathomable how quickly the housing market has recovered, as of the end of November, we're significantly above 2019 numbers on a year-over-year basis. And the pending home sales numbers that tend to show what's happening in January are up 16% year over year from last January. So there was a lot of pent-up demand in the spring. So you can see at the beginning of the year started off strong. And even in March, we were on track for a really good month before the pandemic hit and everything shut down. April, May, and June are usually months where we see growth. We actually saw declines in April and May, and June numbers were still off year over year. But over the summer and throughout the fall, the numbers have come back with a vengeance, and the demand is being driven organically for the most part. There's really three things that are driving this demand in our current story. One is simply demographics. The average age of a first-time home buyer is 35, according to the data. The largest group of millennials is now between the ages of 31 and 34, and the pandemic, and this is the second driver, the pandemic. It accelerated a trend we were already starting to see, which was urban renters becoming suburban homeowners. And when the shelter-in-place orders hit, a lot of these urban renters found out that it was probably not much fun to be quarantined in a 700 square foot apartment with a toddler as they thought it might be, especially when they couldn't go to their favorite restaurant and get out of the apartment for a while. So we've seen a real acceleration in what people are calling urban flight. And we see this happening particularly in high-cost markets, New York, San Francisco, to a lesser extent, Seattle, where you have high-cost markets that people typically didn't want to commute in and out of for jobs. We were seeing people move out of those markets. The vacancy rate in apartments in those cities are going up. The rental prices, guess what? They are coming down. And then the other driving factor is we have historically low mortgage rates. So a lot of people that would have thought about buying, but may not have done so in the past, are looking at a 30-year fixed rate loan at 2.5%, actually less than 2.5%, and realizing quickly that in many markets, it's actually cheaper to buy than it is to rent. So that's another driver of what's going on. We're seeing this in spite of the fact that the inventory of existing homes for sale is the lowest it's ever been since the National Association of Realtors started tracking those numbers. Get that. It is the lowest it's ever been since the NAR started tracking these numbers. And partly, this is a combination of low inventory of homes for sale coupled with high pace of sales activity. But partly, it's just that existing homeowners, in many cases, are reluctant to list their properties because they don't want strangers in the house during a pandemic. They also don't want to be out looking at strangers' properties for their next house during a pandemic. And some people are concerned about the stability of their jobs because of the pandemic. The demand, just to give you another way of looking at the demand, this is the Mortgage Bankers Association weekly survey of purchase applications for loans. So these are the people that are applying for a mortgage, basically. Normally, we're in a down cycle this time of year, but for, I believe, 28 consecutive weeks now, the applications have been higher than they were a year ago. And year to date, 26% higher than they were in 2019. So people are applying for loans in large numbers. You can see a recent video I did when it comes to mortgage predictions for 2021. A lot of data there. I'd highly recommend that you watch it if you want to know a little bit more about what the NBA is predicting for mortgage loans in 21. So high demand, low inventory that drives prices higher. What's been interesting though is you really have a hard time overstating the impact on affordability of those low mortgage rates. So at the same time we're having the Realtors Association talk about record high prices for medium priced homes, we're also seeing that the average mortgage payment on a year-over-year basis for those properties is lower than it was a year ago. Big difference. And that's one of the things that's pulling people into the market. Now, the most recent numbers showed that prices were up nationally over 10%. In fact, I saw something last week that suggested it could have been as high as 17% year over year, depending on the market, your local market. And so you can't have that go on for any predictable period of time. Or if you do, you just hit an affordability wall. Again, I talked about this in another prediction for 21 that you can watch here, right? You hit an affordability wall based off of average income here for your particular area. I don't think we're there yet in the DC metro area, given the high wages earned typically, but I do believe that the next 2 quarters will be interesting to see how the market settles itself. I believe once we get to where people believe the pandemic is more or less under control, you'll see a lot of existing homeowners bring their properties on the market, which will present more buying opportunities, and that should help tame home price appreciation before it gets completely out of control. Now, what about sales of new homes? They've been even stronger than existing homes. And part of this is that urban flight pattern that I highlighted earlier. The National Association of Home Builders is talking about an unprecedented percentage of these new homes for sale being for properties where the builder hasn't even broken ground yet. So you have people buying homes on spec. The last housing boom that we had, builders were building on spec and they were putting up a lot of properties, not knowing if anybody was going to buy them, but assuming they would. And they wound up overbuilding. This time, it's just the opposite. We have people going out to developments and paying full price for homes that the builders haven't even started construction on. But most people were predicting that we'd wind up with somewhere between 600 to 650,000 new homes sold this year. We'll definitely wind up exceeding that in spite of the pandemic, which is very surprising to many. I was surprised by this. And these numbers continue to improve. The builders would be selling more, except they have nothing left to sell. The inventory of new homes that have been built that are available for sale is also at a historic low. Unprecedented demand, really historically low inventory. And part of the inventory that's missing also is distressed properties. We're not getting existing homes. We're not getting new homes. The numbers we need, we're also not getting distressed homes. And that would seem a little unusual because if you look at the mortgage delinquency rates here, the serious delinquency rates, and those are loans that are 90 days or more past due, are at historically high levels. And this would normally be a big red flag and something we should be very concerned about, because normally what's your 90, 120, 150 loan, you're either in foreclosure or you're about to be in foreclosure. Kind of no questions asked here, right? Well, that's not the case this time. And there's a reason these numbers are as high as they are. And the reason is that we're seeing a lot of those loans in forbearance. The CARES Act Forbearance Program, has right here, the CARES Act Forbearance Program has done exactly what it's supposed to have done. It's giving homeowners in financial distress the opportunity to avoid really an unfortunate and probably unnecessary default. And there's a lot of confusion about this because a lot of people don't think the forbearance loans are actually in the delinquency numbers. They are. The individual borrower is not being tagged as delinquent for the credit bureaus and the credit reports, but the loans are being notated as not having a payment made in whatever number of months. And if you remember from my prior videos, the forbearance program was designed to give homeowners an initial 180 days of grace with an option for another 180 days after that. And that's on government-backed loans. And that makes up about 2/3 of the loans in the market today, the government-backed loans do. But most of the private loans, the other 30%, they agreed to kind of play along by the same rules. And so what we're really seeing, if you really follow the numbers, what we've seen over the last couple of months is month over month declines in overall delinquencies and even in serious delinquencies. But the loans that are past 90 days delinquent aren't getting more and more delinquent. And that's the real bizarre thing is, let's say you started with the program back in March. You could be in that forbearance program for a full year. You could be 360 days past due on your loan. And on day 361, you can agree to a repayment plan with your lender and you become immediately current. And this is an anomaly, folks. It's something that's never happened before. We've never seen this. And so when people look at these numbers and expect them to behave like the numbers have always behaved, they're going to be completely out of character. While we have seriously high delinquency rates, foreclosure is at an all-time low. And if you look at where foreclosure starts today, courtesy of Adam Data here, they're actually at lower levels than they were way back before the last foreclosure crisis was even a thought or even on the horizon. We're just not seeing any foreclosure activity at the moment because of the government's foreclosure moratorium. And if you're following that, you saw that FHFA, which runs Fannie Mae and Freddie Mac, extended their foreclosure moratorium through the end of January. The FHA recently extended theirs through the end of February. Candidly, I believe that it's likely that the Biden administration extends the moratorium at least through the end of the first quarter and possibly even into the second quarter as well. What does this mean? Well, it means that there is a foreclosure backlog building. When the pandemic began, there were about 250,000 properties in foreclosure. Those all froze in place. Those are part of the loans that are seriously delinquent, that aren't in the forbearance program. There's about 700,000 of those loans. About a third of those are loans that were already in foreclosure prior to the pandemic. When the moratorium expires, those loans will all come right back into the pipeline and probably be expedited. There are a number of loans that would normally be going into foreclosure for the reason that loans always go into foreclosure: a loss of income, a divorce, a death, a medical expense that wasn't expected. And if you look at unemployment rates between pre-pandemic and where we are today, they've almost doubled. Now that's still lower than most economists predicted by the end of 2020, but we went from 3.5 to 6.8, 6.9%. That would not be unreasonable just to do some back of the envelope math to suggest that maybe foreclosure rates also double if unemployment rates stay about the same as we go into 21. All that said, that would get us back to normal levels of foreclosure. So for anybody who's expecting another tsunami, another repeat of what happened from 2008 to 2011, I don't personally see that happening. The data doesn't indicate this. In fact, what I do see happening is there's a record level of homeowner equity. We talked about this in one of my prior videos, the home equity boon, about $6.5 trillion. According to the numbers, 70% of homeowners have more than 20% equity. So if you're a homeowner in financial distress and have 20% equity in a market with extreme demand like we are right here in the Washington, D.C. area, and you have limited supply and you can't sell your home before foreclosure, you've done something terribly, terribly wrong because you didn't partner with us to help you. And I suspect that that is what's going to happen to the majority of properties where the homeowners are in financial distress. They'll be sold prior to that foreclosure auction taking place. And most of the inventory that goes to auction will sell before it ever goes back to the banks. So for anybody who's looked at the distressed industry in prior cycles and waited for those REO properties, those bank repos before they started looking to buy, I think this particular cycle is going to be very, very different. But what about forbearance? Let's talk about forbearance. You can see that as the end of the year, about 5.5% of mortgages are in forbearance. There were some economists who had predicted that 25 to 30% of borrowers would be in forbearance. Thank God they were wrong. The program peaked at about 8%. So at about 5.5% of people in forbearance, we're looking at 2.7 to 2.8 million borrowers who are still in mortgage forbearance. By the way, about 20% of them have been in forbearance but have never missed a payment since the beginning. And that's a very surprising number. but they are either hedging their bets or just figured out that they could do more with their $1,500 or $2,500 a month mortgage payment if they put it into savings, build up their cash reserves, pay down other debts, or invested it with Webull to get those 2 free stocks, link below in the description. These are people that have just taken advantage of the program like Chauncey did in the video here, or hedged their bets. And you can see that the number of requests, and this is one of the reasons I believe the program is working the way it's supposed to, the number of requests peaked at the end of March. The program was announced then, and we had a huge spike in people asking to get into the program. And I would submit that if the situation were getting worse, we would have seen subsequent spikes at the end of April into May, into June, into July. And in fact, we've seen just the opposite. The last couple of weeks, we've seen a minor, and I mean really minor, increase in the number of requests as we get close to the program's expiration date. The last couple of weeks, we've seen an increase of maybe 0.1, 0.2%, but generally this has flatlined. The other thing that's really, I believe, indicative of the fact that the program's working in the way it's supposed to is that these are obviously MBA numbers. 81% of forbearances are either on extension or have re-entered after exiting the program. And again, keep in mind, the program was supposed to be 180 days and another optional 180 days for a full year. The bulk of people will be exiting by March, but the lenders, the servicers who offered the forbearance actually didn't go out and offer 180 days. They typically do this in 90-day periods. So you're in it for your first 90, you ask for an extension, now you're in it for a second 90, you got to the end of that, maybe you asked for another extension. Some of the people exited the program without having contacted their servicers to figure out what their options were. And we've seen them cycle back in as re-entrances to the program. But the fact that the majority of people that are in the program are either extend or re-entering leads me to believe that the program is working because there's fewer and fewer new people coming into the mix. Again, it shows me less distress than you would expect during the course of a recessionary period. And this is probably one of the more informative charts right here. But people have been exiting the program, and 87% have either simply continued paying their loan because they've never stopped, they've had their loan reinstated, have put together a deferred payment plan, which takes their missed payments and puts them at the end of their mortgage. They've entered into a loan modification, a loan repayment program of some sort. They've paid off their loans by either refinancing or selling the property. Get this, only 13% have left without having one of those criteria in place. And as I mentioned, some of those are reaching back out to the servicers and re-entering the program. Now, this is since July through the beginning of December. So the numbers of people exiting without a program in place have gone up a little bit in recent weeks, still in the 20% range or so. So you're doing an 80-20 rule, but this is what gives me the most hope, that as we exit these government programs, we're not going to have the kind of carnage that you might expect with 40 million people losing their jobs during this pandemic-driven recession. Now, what are my closing thoughts for 2021? Well, let me share those with you now. It is my belief that based off the data we're seeing, that the housing market surge is going to continue in 2021 because of demographics, mortgage rates, and low inventory. And then again, some of these homeowner trends the pandemic has caused to accelerate. I don't expect that we will see the kind of year-over-year price increase that we saw this year, 10 to 17%, because I do think we'll see more inventory come to market, but I don't expect to see a slowdown in buying activity, either in existing homes or new homes. The Fed said that they weren't going to raise rates until 2024 or even 25. I wouldn't be surprised to see another increase somewhere in the neighborhood of 5% in terms of home appreciation and home buying next year. Foreclosure numbers are artificially low. They're going to remain artificially low until these government programs expire, whenever that is. And keep in mind that if the moratorium and forbearance programs all end in March, everybody who's not already in foreclosure basically starts at that point. You're probably 90 to 120 days from a lot of those borrowers being put into foreclosure, which takes you to the end of the second quarter, beginning of the third. And then when those properties actually wind up coming to the market, really just depends on where you are in the country in terms of where you'll start to see some of those distressed properties hit the market as foreclosures. Now, it would be crazy for me to tell you we wouldn't see default activity increase with all the job losses, but for all the reasons we've talked about, I think it's unlikely we're going to see the kind of numbers that we saw during the Great Recession. And keep in mind that we entered this pandemic running at about half as many foreclosures as we normally would have seen. So the market and the loan quality was extraordinarily strong. And then ultimately, what happens in the economy? Well, what happens in the housing market is really going to be contingent on how well we do in getting this virus under control. So now you know what's happening, what's likely to happen in the short and the medium term. You know the things to be watching. So what do you think? Are you planning on buying? Are you planning on selling? Are you planning on holding off right now? Leave me a comment below and let me know. Let me know if you have any questions. And of course, give me a thumbs up if you like this video. Feel free to share it with someone you think would derive value from it. If you're not a subscriber and you want this kind of content on the weekly, just hit that subscribe button. And as always, thanks for watching, folks, and I'll see you on the next video.